You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
And welcome to a special Leap Day edition of the Option Block. I am your host, Mike Tussaw, filling in for Mark Longo today. It's a little known fact that he does not work on leap days, folks. No, just kidding. He is actually out on assignment today, but we will do our best to fill in his big shoes for the day. Joining me from the great Northeast, the great state of Maine, is my co-host for today, Mr. Andrew. Andrew, how you doing today?
I am doing swimmingly well in the state of Maine. It's actually warming up.
Swimmingly well. So it's so there's no ice skating at all right now.
There is. You know what was funny? There was a perfect ice skating day on Saturday, but I had too much stuff that I had to do. We did our boot camp and everything in the morning. But for whatever reason, we had like 3 days of free. So all the ponds just had, a lot of them had just this perfect frost on top. But of course I couldn't do it because I was working. So.
Too bad. Well, it's Maine. I'm sure you'll get another chance.
I'm thinking not this year, but probably next year. It feels like every winter it gets cold here.
That would be the case, I would guess. And, since I'm the host today, we're going to have a quick Maine segment right now. Northwood's Law. Have you ever seen that before?
I have not.
I forget what.
Is it going to be exciting?
Well, I see it. It's about the police. It's about like the police officers in Maine who patrol like the lakes, the forests, and things like that. But if you have not seen it, I can't get verification on what things are really like in Maine. But if you get a chance to watch it, take a look. I'd be curious to hear your take on it.
I will give it, because I think there's a motorcycle show filmed here. There's actually a lot of shows filmed in Maine. I was surprised, but anyway. But we have a lot of trees and natural beauty, so I guess that makes sense.
It's your and I's job on this show to prove that life can exist outside of Chicago.
Exactly. Well, let's see who gets to put the dock in the water first this season.
There you go.
I'm looking at pre-Easter.
Oh man, I don't know if I'm going to swing that. But I have a river though, so if we do get a little bit of a freeze and a nice chunk coming down river, it's tough for me. So.
Oh, that is a problem.
Yeah, so I'm a little bit. I buy my puts a little bit closer to the money when it comes to putting the dock in the water.
Yeah. There's a low tolerance for failure there.
Yeah. So, anyhow, today. In terms of what's going on with the market, let's dig into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
We have some kind of weird things going on today. We were talking about a little bit before the show in terms of gold going up. We have treasuries going up a little bit. We have the market coming down a little bit, although it is relatively high. Oil coming up. It's a lot of things just aren't matching. And then the fact that oil's up and XLE's down. I mean, there's just some weird stuff going on today. Andrew, what's your take on things?
it's the central bankers. I think China lowered capital ratios for banks. And I think that, there's like this crazy heroin addiction to monetary easing this, easing that, debasing currencies. And I think all the central bankers are hooked on it like it's going to fix something. Japan has tried it, and I guess after that huge market rally, they've sort of that whole thing has sort of fizzled. So, until I guess policymakers improve growth policies, I don't understand what the heck they're doing. Frankly, it's all a little confusing to me as far as, and I think that's making all of the assets act weird and strange.
Weird and strange policy would entail weird and strange markets, one would think.
I would think so. And, gold, it makes sense that gold is going up because all of a sudden everybody thought, well, there's no inflation. And now, since there's sort of no end in sight for the central bank, in the U.S., it looks like they're at least stopping. Obviously, they're trying to raise rates. But, everywhere else they're not, and that is making I think market participants nervous, and the central bankers are kind of running out of ideas. So, in that case, what holds its value? So I guess Treasury bonds and gold. I guess that's, and we kind of lurch between that.
It does. Like, 'cause one thing that I've thought, there's a book a couple years ago, and I like some of the things he says, and I can't say I agree with everything, but Jeremy Siegel wrote a book a few years ago on dividend stocks. Excuse me. And a lot of it had to do with tried and true beats bold and new every time. And the concept of it was that back in the old days, back in the 40s, 50s, stocks paid a lot higher dividend yields. And right now, stocks on the S&P, the SPY dividend yield is just a little bit around it's around 2%. And so it's not very big. But with that, a lot of times over time, dividend paying stocks don't get the big runs like Apple did pre-dividend. But there's something about when a company is forced to actually pay money, they seem to be more disciplined in that they don't have the big run-ups, but a lot of times dividend paying stocks don't get pounded quite as badly in market downturns. So with that being said, does that mean all dividend stocks are really good? No. Good gosh, no. Just look at Bank of America back in the 2008 crash. That's not the case every time. But there is something to the fact that companies that do pay a dividend tend to do a little bit better in a market downturn. Would you have any thoughts on that? Just because of the fact that once you get to the big leagues, like where Microsoft is, where Apple is, where AT&T is, everyone knows those companies. What other market share are they going to get? But if they pay a dividend to people and they do something along those lines to share in their profits that way, it could be something that could help them. Do you have any thoughts on in the dividend world, Andrew?
I think I like that. I own a lot of it. I own more dividend paying stocks than not, mostly because for an equity portfolio, I just wanted to just generate some money. And then when the economy grows, generally stocks will go up. And then there'll always be that every 10 years, there's a panic when you really want to make sure that you can buy some equities because they'll be really cheap. So, that's sort of the my history with looking at stocks. But also, you look at some of the yields on some of these things now, and all of it is getting a lot more attractive, which is more to add to the strange brew of what's going on with the economy and really what's going on with, everybody's perception of it. So, you could buy AT&T, it's not going to grow very much, but it yields 4.5%, which after last year, 4.5% doesn't look so bad. If you write some calls against it, all of a sudden, maybe you're up to 6%. So that starts to look appealing. People probably aren't going to dump their cell phones. And I guess that's what the mentality is after a while. But, dividend stocks overall, I read a kind of an interesting stat half of the returns of the S&P 500 over the last 40 years are through dividend reinvestment. I found that very interesting. So every year you just take your divvies and you go buy more stock and you get more dividends and you compound it. And I think it works for Warren Buffett. So
does that guy have any money at all?
The last time I checked, he just does it on a bigger scale. He just buys companies, and all the money that those companies make, they get brought to the mothership, and the mothership collects all that money and goes and buys more companies that generate more profits, and then they just keep doing it. So I'm pretty sure it works over time, because the richest investor on the planet, that's what he does. And you just got to keep doing it till you're 80, like he did. He started when he was 25, and now it's 55 years later.
Yeah. So when he talked with his financial advisor 60 years ago about long-term investing, he wasn't kidding.
I guess that Ben Graham, he picked the right one.
There you go. There you go. Moving onward, anything on the VIX to report to us today?
What I thought in the morning, looked like a serious kind of drop in volatility. We had the weekend effect happen early, and then we were negative for the day. I think VIX actually traded deep into the 18 handle, like 1838, 1840, something like that. And it looked like everything had just stopped. Stocks were looking okay. By the way, that 18, I was a little bit of a surprise. The 18 print, 1838 was a misprint. I think the real low was more like 1920, something like that. Because 1838, that would be pretty low. Because when I was watching it, I don't remember it crossing 19. Anyway, and vol sold off. The market was kind of rallying, then everything just sort of turned around again. And we had a bit of a bid for volatility going into the close. There was a bit of a bid for the vol futures. But once again, VIX is already trading 20.5, and the market's only moved 0.5%. So, VIX is still overpricing, right? At least right now, VIX is what I would just say is fully pricing any market move. And if we don't start really moving soon, I'm going to assume the vol is going to have to go down. But it feels like there's so many people that have bought puts that it's I guess they're waiting for something to happen so they can sell. That's what it feels like. Well, they're waiting for the sell-off that might not come right now, but could happen later in the year.
Okay, now shifting gears a little bit, there's a big event coming up tomorrow, and that event is Super Tuesday. Now, I know we're not very political on this show. We're pretty much riddled with sarcasm whenever politics seems to be getting involved in everything, but we'll call this the sarcasm block right quick. With Trump, Rubio, and Cruz being the three Republican frontrunners, and in reality, I personally think it's kind of pretty much Trump's game to lose at this point. I think a lot of people would agree with me on that. Along with the fight between Hillary and Bernie, what are some thoughts? Do you have any thoughts on how that could play an effect on the market? A couple months ago, when Hillary said that she was going to do everything with which she could to fight against the evil corruption of pharmaceuticals, and then, well, quite frankly, pharmaceuticals went down quite a bit that day. Any thoughts or anything that maybe your listeners or your students or anything is playing on how the results might happen, or anything that maybe that we need to be aware of or that we should be looking for tomorrow with Super Tuesday at hand?
Right now, I think, at least student-wise, they're all, I think, Hillary probably is which will end up being probably end up being the most middle of the road of everybody after it's all said and done. I don't really know. As far as, I don't know if Trump can beat somebody in a nationwide contest. I guess it's just this is the strangest election I can remember. That's all I can say. And I think mostly just there's some people are fed up with the institutions we have. They're not really performing very well overall. So, and I think that's why an outsider might have a chance this election. I still don't think it's too late for Bloomberg to enter the race. So
Really?
Most of the chat in our room involves the possibility of Michael Bloomberg jumping in.
Got it. No, that would be that would be an interesting scenario if Bloomberg actually jumped into the race. You guys think that it's not too late for him, huh?
He basically he could very well grab all the candidates in the middle if Hillary positions herself too liberal and Trump is just I don't even know where Trump is. He just seems mostly angry when he's on. So I don't really know what I guess I knew some of the positions, but I can't quite figure that guy out, to be honest.
No, and it's one where you're right. I don't think there has been a more angry candidate in the history of all presidency. And, I would just like to see the guy laugh once. I don't think and what's funny too, we actually decided to just get a movie for the kids last night. We just were randomly picking one. So we picked the 1994 version of Little Rascals. Donald Trump actually has a cameo appearance in that. It's actually quite comical to see. So if you ever want to watch the movie Little Rascals, Trump's cameo in there is quite unique, to say the least. So
now that is something I'll bet not many people would have guessed.
No, at first he looked so different in the movie. I wasn't sure it was actually him. I thought it was just an actor that was supposed to be playing him, but it really was him. I looked it up. The movie was made back in '94, and it was quite the appearance. But anyway, before we get on to the odd block, let's slide right into that slippery stuff that always seems to be making the news these days. And that's oil. Looks like oil today was up another $1.10. And with that, the market couldn't rally on that. So a lot of times people were kind of basing some of these market rallies on oil coming up. And today that wasn't the case. Any thoughts on oil volatility, or just anything slippery?
Anything. Well, since the ice is melting, I don't have a lot there. Oil, I think oil is at it at a 1 week high today? We were just looking at some of this. Nope. It was a little higher into the close last week. But the fact that it's not going down and it's not in the 20s, I think is pretty good. And most of it has just been on speculation of OPEC tightening, I believe. And it hasn't really happened yet. They keep talking about it. I guess mid-March they have is the next OPEC meeting. Although you look at stocks like ExxonMobil, that was trading for 72, is now 80. Most of the drillers haven't really recovered much, but some of the mainline oil companies have not really exploded, but definitely sort of, at least they've made a pretty good bounce off the bottom. And oil really hasn't done much, except apparently, it seems like it's exponentially worse for every dollar it goes down below, let's say $26 a barrel for, those companies. They have a much harder time. So, but, I thought oil rallied today. It's been firm and we got no market rally. So for a while, there was a strong correlation between those two. And at least for today, it sort of broke apart. So I still think the whole market's confused about when the next shoe's going to drop.
Time will tell, that is for sure. So with that will conclude the trading block today, and let's slide right on into, as Mark Sebastian would put it, the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Welcome to the Odd Block, everybody. This is where we look at things. Well, you guys should know the drill by now. We've had over 500 shows. This is where we look at calls and puts that were purchased in large lots that just seemed a little bit odd. First one we have today is a former sponsor of ours from the show, ironically, Charles Schwab. Shares of Schwab are up 2 pennies on the day today to $25.48. It's near the low end of its 52-week range. Paper traded 695 Schwab SEP 28 calls for $1.75 today. The ADV is 4,876 contracts, and the open interest in that strike is 61 contracts. Volume went up in one block at the PHLX exchange. Over 13,000 contracts traded on the strike, with buyers sweeping the offers in large blocks on all floors. Most of the volume occurred within the 1 minute span in the morning closed to open. This could be a hedge or a net long. Schwab expecting to make a move higher. Andrew, what thoughts do you have on this?
This was a subject in our chat room for a little while. Like, why would somebody buy a bunch of September calls in Charles Schwab? I mean, you think about it, that's a pretty big chunk of volume, don't you think?
I would agree, yes.
And all the calls are 20 cents lower today. I mean, the stock did go down a little bit here. We had that quick sell-off at the end of kind of the end of the day. It looks like the market's kind of bouncing back. But I guess there was the preferred was selling off. I guess Schwab has a preferred stock. That's one of our clients said that. It looks kind of like some sort of a hedge type trade. I guess somebody could want to buy those, but Schwab is not really kind of a mover and a shaker for a stock, but maybe they think something fantastic is going to happen. I didn't see any stock go up against this particular trade either. So nothing on the order of 13,000 contracts. But the real interesting thing is, you know how I could tell we have a lot of exchanges? Because these calls traded on every exchange that lists Schwab as a stock. I mean, there are exchanges I haven't even heard of.
Maybe Schwab as a holding company, they might look to buy exchanges, and they're trying to run business to the exchanges that way.
I guess so, but anyway, a lot of the calls traded about $1.80, and they closed $1.65. So at least for today, they got a lot of time to be right, but at least for today, they are very wrong on this purchase.
Got it. Next one, ENB, Enbridge. Shares are up 64 cents to $35.38 today. ENB is also near the lower end of its 52-week range. Paper traded on the ENB March 37 half calls at 35 cents. ADV is 791 contracts. Open interest is 63 contracts. A lot of volume in one block at the PHLX. Likely a call buy rider looking for high dividend yields in the MLP space. Calls could add about 1% per month to the cash flow in the stock. Thoughts on this, Andrew?
I think this is our standard buy rider, just trying to grab that extra yield. Probably a hedge fund or a pension fund or something like that. They own a bunch of the stock, and at 35 cents, that gives them 1% per month. I think Enbridge, I have to look at the divvy. I thought they paid around $1.50. It pays a pretty decent dividend, but given where the stock is, let's see, 40 cents. So it yields about 4%. And then with the calls, all of a sudden you're up to 16%. That's if the bottom does not continue to fall out of the MLP space. So at least for now, it looks like it's holding up.
It does, and I've looked at that a lot in the past, and I've never really made a serious strategy out of it. But you get tempted by looking at those high-income MLPs, ones, and I'm not talking about the Enbridge of the world, but like the ones that pay like the 8 to 10% dividends, and maybe write a call option on it. There's no way that you're going to edge it, meaning that the calls are going to be so much less than the puts. You're never going to collar something like that. Trust me, folks, I've tried. It doesn't work. But a lot of times you can get some really serious yield from it, but almost every time you look at the volatility of the stock, I've never been able to pull the trigger on it and justify it. In your years in the trading world, have you ever tried to do anything serious with the high yielding MLPs or just the very high yielding stocks?
Besides buying them every once in a while, I haven't sold options in a serial way against them like this. I just never, I never thought that it was necessarily worth it on any substantial amount. So, but I see a ton of paper go up in these, but the problem is, a name like Enbridge, it was $43. Now it's 30. You're writing calls on that. It was $55. The 2-year high was $52. And a lot of these have really bounced pretty hard off the bottom, but you're still, you're trying to make 1% a month, and all of a sudden, the capital loss is more like, $18 over 6 months. You're going to be writing calls for a long time, I guess.
Well, I guess you just keep writing more calls.
I guess that's what you do. You just keep going. You just have to keep going and going and going. So what are you going to do?
There you go. Last one, SIG calls. Big trade ratio call spreads go up. Signet Jewelers, SIG, they're up $11.18 up at 11. They're up 11.18. What the heck is this show note that Longo gave me here? SIG is up on the day. It's near the middle of the 52-week range. Paper traded on the SIG 115-120 ratio call spread, a 1x2, which would be 4,600 contracts bought or 4,600 contracts by 9,200 contracts. ADV on this is only 3,266 on the day, and then the open interest is 744 for the 115 call and 2,800, just under 2,900 for the 120 call. Volume did go up in several blocks, but the trade did end up being closer to a 6,500, 13,000 ratio spread. Any thoughts in the world of the ratio?
Well, very interesting. It was the handle was 110. That was a typo from me. Sorry to do that to you.
My goodness. That's all right.
But Signet, aren't they the Zales? They're the Zales jewelry people. Every gift begins with Zales. Isn't it something like that?
I think you got your alphabet wrong on there. But anyway.
And anyway. Oh no, that's K Jeweler. But
every kiss begins with K. It's a play on words.
Every kiss begins with K.
Because the letter K is the first letter of KISS, and then K Jewelers is the name of their company, so it's an ingenious play on words.
It is, and I totally screwed it up. However, this is actually Zale. And I didn't know Zale also owned part of the Piercing Pagoda.
I was not aware of that myself.
I did not. I don't even know what a Piercing Pagoda is, but, they own it. They own 3,500 stores. That's a lot of jewelry stores.
That is a lot of jewelry, yes.
Okay, but besides all that, somebody I think wants to buy them. The stock was up a bunch. And the trade that went up was the 115-120 call spread on a 1-to-2 ratio, buying 1, selling 2, it looked like, for even money. So my guess is this trader with SIG trading around 110 or 111, right around there, they think there might be a little bit of a topping bid, but they just don't want to spend a lot of money for it. So they are buying the 15 calls. They just think a topping bid is not going to be above 120. And they did this pretty good size, total like 6,500 by 13,000. So somebody is a little bit bullish on a topping bid for the old Piercing Pagoda.
It all goes back to the Piercing Pagoda, doesn't it?
I guess that's a growth business.
There you go. All right. Well, on that note, folks, that is going to conclude the odd block for today. And because of this week, I will not be here on Thursday. We may or may not have a show at this stage on Thursday, but time will tell. We'll see if we can work something out. But we are going to forego the strategy block for today, and we are going to have an extended listener mail.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, Andrew. We have our first question of the day from listener mail. This is from Alex. Question. Mark, thanks again for covering my question. I agree that I am not capitalizing on the theta curve as much, although $5.30 per day is also decent. However, my intention was more to capitalize on Vega surface, where Vega tends to be much higher at longer maturities, as it was especially bloated during the earnings date when volatility spiked to the highest level. Now, this is a question, I believe this is a follow-up from when the gentleman had wrote in asking about writing a longer dated put, to kind of give everybody some perspective on this question who was not listening to the previous show. And if you weren't, shame on you. Given that the volatility levels are at its highest, then Vega itself is expected to be at its highest level. That said, I am not really set and forget strategy and collect on premium theta. I just have to wait until volatility normalizes for LinkedIn and collect on decent premium Vega. In a sense, I am shorting both volatility and Vega. Hence, further out months give richer Vega to short. And if I were to write shorter maturity puts, then Vega would have lost its juice in a month or two. As a side note, I entered into a cash secured put. I don't trade on margin yet. Approximate yield is 15%. Below is a screenshot of a general Vega surface, which, by the way, folks, you can't see this, but it's quite an extensive diagram that Alex sent us. Thank you, Alex. It would be a separate exercise to compute the Vega surface for LinkedIn. Maybe this question is an overkill for the show, but at least these were my reasons as to why I shorted a 1-year put. Cheers, Alex. So with that, this question's right up your alley, Andrew. I think what this adds to is that, yes, you're not getting the same kind of theta when you sell a longer dated option. However, is Vega typically greater when selling a longer dated option? And what would the relationship between Vega and theta be when you're short both of those two Greeks?
Well, the thing is, I'm looking at his asset. That is a lovely vol surface right there that he gave us.
Yeah, this is the best diagram we've ever had sent to the show, Alex. You win the prize, no doubt.
Yeah. There's no question. Maybe we can get him a copy of Mark's new book when he finishes it. But it looks kind of like the Matterhorn at Disneyland, but much more colorful. That might give you
the colors too.
A clue. So here's the thing. There's a couple of Greeks that he's. So for sure, when he's selling the 1-year put, volatility, or when Vega is priced out there, you're basically selling more Vega when you sell a contract. So, if you sell a 6-month put, you're selling a lot more Vega per contract than you are a 1-month put. So they're deciding, well, if volatility, like in LinkedIn, is pretty high, the stock just dropped $100 on the last earnings cycle, and volatility is pretty pumped. So he's like, you know what? I want to buy LinkedIn, but really, I'm not expecting it to really bounce a whole lot. And I think it's stuck between right around 100 and 120. So he's going out 1 year. He is selling. I think I'm looking at 1-year vol for LinkedIn. It's probably nothing like a 300% volatility to really make things interesting. And he is selling 1-year volatility at a 2-year high. So, what can you sell? You could sell the. Let's see here. He goes out to 2017. He could sell the 80 puts for $6, and at $6 return all in on the stock at $80. That's not a bad return. It's not 10%. It's more like, what is that, 8%? But that's still pretty good if you don't think anything's going to happen and you're going to take LinkedIn at $80. So he's selling the relatively high volatility because he really doesn't think there's also a lot of upside. But he's saying here, in a sense, I'm shorting both Vega and volatility. When you sell that far out option, it really doesn't decay that fast. So while you're short the option, it's certainly not decaying against you. You are not you're not expecting any sort of, let's just call it, the daily drip is relatively small. And, to me, it's just, if you want to own something and the volatility goes to the moon, I would rather sell a put farther out than closer in, because if the volatility does compress, even if LinkedIn really doesn't move, he's going to make really good money on his puts. And you also have, this is something he really didn't include, you have a whole lot less short gamma for the position. Sometimes if you move a little closer in term and LinkedIn falls out of bed, that the effect on your position could be a little steeper. So I'm seeing, I guess he's given the reason that's why I sold a 1 month out put, because I've got a lot more Vega out here. And that makes total sense. He is also less, I know it sounds strange, but he is more insulated from a move in the underlying as well when you go that far out, because you're selling a $6 option instead of a $1 option. Right? The whole reason why market volatility, when market vol goes up, options get more expensive. So liquidity providers, instead of selling options for $1, they'll sell them for $20. So on a percentage basis, if the market moves, it has to move a whole lot more for them to lose money on an option they sell for $20. And that's exactly the reason in LinkedIn, because, if they're pricing a pretty big bounce, that sort of pricing will also make, if it makes the calls more expensive, it's also going to make the puts more expensive. And I think it certainly doesn't sound like he's making the trade for all the right reasons. Now, whether LinkedIn, stays $100 stock or not, I have no idea. But as far as he's getting the most bang for his dollar by selling that put.
So you would not put this in the same category as selling an at-the-money call on a $100 stock for 2 cents.
It is definitely not the same category.
That is good.
He's built in. I mean, you could sell an 80 put for $6. You're building in another 17 and 26. He's building in another $42 or something like that of downside. So I think this is just a much better way to go.
I was gonna say, yeah, now that we know all the details of the trade, I definitely like it for sure.
Yeah, much better idea. And I think that is not too far away. Weren't you selling puts in the TLT or something like that?
Yeah, I got right now. I'm still short the 120 puts in TLT for September, and it's a similar concept in that I felt the Vega was high enough, in that I shouldn't say I didn't really look at all as Vega, but my thought process behind it was that this is designed to be a way with which I don't want to necessarily be net short bonds, but I don't want to be long them either. And this is a way with which I can have a really good chunk of downside protected should rates start to rise again. Or should TLT start to go down again, whether rates go up or not, it's, I guess, irrelevant in relation to the Fed. But if TLT just goes down, I have a really nice cushion. And if it went down that much, I'd probably be fine owning it at that point. But even if it doesn't go down that much, it came out to an annualized 4% yield. And that's why I liked it for that section of the portfolio.
Yeah, and if the market falls apart, that's 4% you get to keep pretty easily.
Very true. Very true. So there is a place for it. And thank you very much, Alex, for the questions that you've wrote in. And definitely thank you for the graph. Moving onward. This is a question from JM. Hey, folks, I thought this might be a great question for the option block. Would you mind talking about the limit order display rule, Exchange Act Rule 11AC1-4? How can it help the retail investor? How the rule is applied to SPX and VIX options? When reading the actual rule, it can get a bit confusing. I would agree, because it's talking about odd lots and block size orders, etc. Would be good to get your take on it. Perhaps the Rock Lobster may have an interesting perspective as a former market maker. Great program. Cheers, JM. So I guess what this is, Andrew, is just to kind of even expand on this question in that, how do you display limit orders in that? How can this move the market? And what's the point of the regulation? I know there's rules against painting the tape and things like that, but as a former market maker, what are some of your thoughts on just displaying orders in general, even if you don't have any thoughts on the Exchange Act Rule 11 AC 1-4? What are some of your thoughts on just order displays in general?
This is kind of and what's funny is how much the rules might have changed since I was a market maker. In the old days, basically, you had to post any limit order, which means that, a one lot gets posted and it goes up between the markets, right? If it improves the markets. There are other types of trades that can be all or none orders, which don't get posted because they can't post an order like that. They have to be held by a broker somehow, or in the system they have to be held. So it makes that type of trade. A lot of times when you have a block trade where the customer says, okay, I need to buy 1,000 of these, but I'm here to buy 1,000. So let's say I'm a 1 1/4 bid and a broker's working the order, but they have to buy the whole 1,000. So they're trying to work a live order to get it filled at a price, and if they can't get it filled, the customer doesn't want to do it. So those orders could actually move through listed markets. So in the old NYSE days, you could be sized out. If 2 blocks trade, it could leave smaller orders kind of out of the loop. Mostly, what we try to do is try to trade everything kind of below a limit. If people wanted to sell something cheaper, and then if you print it at a higher price, everything prints at the higher price. So the problem is essentially they have rules, and then they also have rules that kind of lets them get around the rules. If there's enough size, or there is some sort of funny, not funny, but some sort of out of the ordinary tag on the order. If the customer wants to buy 2,000, right, and he'll pay X dollars, and if he can't buy it, he doesn't want to do it. So they're not going to post that kind of a bid on the screen. The whole reason why they're having the broker hold the order is to try to get the order flow to fill it in the first place. So there's a lot of room on there. But in general, if you post an order and it trades through your limit, you should get filled. But there are some exceptions for size, and also, like I said, for qualifiers on the order itself. So that's what I would say to JM. Hopefully that helps them. But the exchange is basically, there's kind of a rule in the exchange, and when you sign all your disclosure agreements, that we're an exchange and we have the right to change the rules if we need to change the rules, depending on what happens. Because also remember, during the flash crash, there were trades that were busted, all kinds of things that happened. So ultimately, they can make their own rules up when they want to, which makes it harder. But it doesn't happen very super often.
Unless you're in China.
Unless you're in China and, you get thrown in jail or something.
Got it. So, final question that I want to do today before we go to Around the Block. Question from 777. Euro-dollar futures, do they trade options? And what drives the massive open interest? So with that, I first want to clarify what the euro-dollar is and what the euro currency is. There is a big difference on it that I think a lot of beginning traders get confused on. Euro currency is the currency itself. In America, we have the dollar. In Mexico, we have the peso. In Europe, we have the euro. And in the trading world, the euro is known as the euro currency, typically, if you want to use its full name. Now, the euro dollar is something different all around. It's along the lines of the interest rate that people would pay in Europe or just borrowing money. It's kind of like the Fed rate in Europe, so to speak. Not exactly like that, but it's more of a European interest rate type of futures. And so in terms of what drives the massive open interest, yes, they do trade options on Eurodollar futures, but it is a huge contract in the futures world. And a lot of this is institutions trying to hedge against interest rate movement by using things like that. So with that, Andrew, do you have any thoughts on the euro dollar? Have you ever traded the euro dollar or the euro dollar currency? Or I'm sorry, not the euro dollar currency, the euro dollar options?
I haven't. The only time I thought that actually was interesting, what was it, about a year and a half ago, we actually had somebody on at Option Pit gave us a guest talk about the volatility in the euro dollar options, because the Fed had just basically driven interest rates to zero and said we're not going to move them, which basically destroyed the volatility in the euro dollar options. And somebody brought this to our attention because, I mean, they trade like in a percentage of $100, the underlying. So when we're looking at the options, it was just, you could buy a 1 year out option or put option on the euro dollar. So if rates rose, the euro dollar value would drop. And I would just remember that I heard about it. I go, wow, that really sounds like an awesome trade. and then Bernanke started to say, you know, remember we had the taper tantrum 2 years ago? I think
yes, the taper.
You remember that? And the value that the guy that was euro dollar option trader, you know, probably one of the best trade ideas I've heard in 5 years, and I totally had forgotten about it. But it was great because the volatility and all those puts and stuff just went sky high relative, because they were literally at zero. I mean, as low as volatility can get for a massive macro product like that. And that is my only euro dollar story, euro dollar option story anyway. So I wish it was a really happy one and it would have made me enough to buy, you know, a Tesla or something. But if I would have done it, it would have. But it didn't work out that way.
I only have one euro dollar story myself. I was actually at a party one time to where just small talking, just mingling, whatever. So my wife and I are standing there, and so we had the classic question, so what do you do for a living? And so the guy says, I trade euro dollar options. And so he looked at me expecting me to say, what the heck is that? And I just smiled and said, my good man, I am actually the first person in the history of any party that you've ever been to that actually understands what the heck you're talking about. His jaw dropped to the floor. That is crazy. So that's my only euro dollar future story anyway. But with that, we do actually have time for one bonus question before we go to Around the Block. I know I said 3, but folks, I like to underpromise and overdeliver when I am filling the very large shoes of Mr. Mark Longo. We are going to do one bonus question here. And the question is, can a trader make a living buying puts and calls straight? Or do they have to do crazy stuff like the complex iron condor and things of that nature? So with that, I'm going to yield to Andrew on that one. I will give you pride of place, as Mark would say, to answer this question first.
I guess it's possible. I just have never seen anybody make money buying straight calls and puts. I mean, I shouldn't say make money. I would mean make a living. I know traders that buy option contracts like straddles and strangles or combinations thereof that actually have done really well, that are really good premium buyers. But it takes some practice, because you can end up with a lot of contracts that just sort of wilt away and go to nothing. So the big question is, can you make money buying options? There are a lot of trading firms that make money buying options. Just buying a call, though, and trying to be right with it all the time, pretty tough. I'm more like I'd rather look at a little vol arb. I rather trade the realized volatility a little bit more. So it's usually a combination of calls and puts. But that doesn't mean there aren't people out there that do it. I do know guys that trade straight futures that seem to do okay. But they are, one in 1,000, basically, or less, 1 in 10,000. So I would say it's a tough one. It's a tough road to hoe.
Got it. And with that, would you happen to know anyone that can teach how to do more complex option trades beyond just calls and puts, Andrew? Oh, wait, we'll save that for later in the show.
I had an answer for that one.
I think I know someone too, and I think I know a good guy or a good group of guys. But we'll save that for Around the Block. So with that concludes the listener mail block for today. Now it is time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
And Andrew, we are looking around the block. What are you looking for this week in this special once every 4-year occasion that we call Leap Week? I don't know if anyone ever calls it Leap Week, but it sure sounded cool when I said it. What are you looking for Leap Week?
We do have that non-farm payroll number coming up. And besides the Fed saying we're going to raise and then we're going to lower and then we're going to raise and then we're going to have negative interest rates and like all this crazy stuff that's coming out of them, mostly what we're probably looking for is just, a decent jobs number, which means there's growth, or a bad jobs number means there's not as much growth. And I believe we discussed this one of the last cycles, Mike, but I don't think there's anything in the jobs number that can be good, meaning if there's too many jobs, we're going to raise. Everybody freaks out. At least that's what the algos do to freak out. If the jobs number is really poor, that means they're not going to raise, but the economy sucks and we're going to sell off. So depends on how much the market kind of tanks on it. I would think, though, we would see a VIX under 19 after the jobs number one way or another somehow. That would be my guess, but I'm not willing. We actually looked at some vol trades on this today. So that feels like where that idea is. So right around the non-farm payroll number, and of course on Wednesday you have the ADP number. So those are the two biggies for the week.
Got it. And so maybe an analogy you could use for the non-farm, if nothing can be good, it's like being it's like being short a straddle where you don't know the strike price and you didn't get a lot of premium for it, and it's a very volatile underlying. Would that sum it up?
I guess so. Could be messy.
There you go. All right. So now that we have Around the Block taken care of, that music that you may or may not hear right now, folks, is telling us that we are out of time for today. So with that, let's give Andrew the opportunity to explain to our beloved listener, if you are looking for a place to learn a little bit more about option trading as opposed to just buying and selling calls and puts, where can you go?
You can go to, let me see, this place called Option Pit for education. We just put our beginning boot camp, our entry-level course. We've never done one before, for people that just don't know anything about options at all and want to learn something. Maybe that course will save you money and then you'll never trade options again. Where you're like, wow, I maybe could do this, or I could think of ways to use this, and I'm going to go for it. But we talk about volatility. We talk about long options, long calls and puts, how to make those things work, what to look for. So that will be available in our store and our website probably within a week or so. But that's basically what we got going on. We'll have one of our new Saturday classes will be coming up shortly.
Is it a Leap Week special?
It could be a Leap Week special. I guess I got to post something.
Leap Week special.
I'll tell you what, though. For a Leap Week special, anybody that sends me a note at andrew@optionpit.com that wants to take our gold course, which you learn a ton in. I can't think of a course that gives you more information for less money than ours, but I guess it's possible. And your Leap Week special, just say Andrew sent you, and I'll knock $200 off the price of the gold course for you. How about that? Can't get much better than that. The Leap Week special, andrew@optionpit.com, and say, I heard it on the Options Insider Radio Conglomerate, and I want to take the gold course.
Love it, love it, love it. And folks, if you are not looking to necessarily trade your own money and you would like to have some type of exposure in the world of options, whether it's through long-term stock holdings or having the options protected, or basically just have a financial advisor that's an option guy, for crying out loud, give me a call. I'm an option guy. You can reach me at 312-212-3531, or you can send me an email at mtusaw@rcmfs.com. Folks, because of the fact that I'm very scaled and I have most of my clients online, I do work with smaller accounts as well as larger accounts, but I'll even put this out there in that if you have just maybe a couple $100 a month to invest, then feel free to contact me. Would love to work with you in any way, shape, or form. And with that, I would like to thank my co-host for this show, Andrew Giovinazzi. It has been a lot of fun, and looking forward to having the show again next week. So long, folks.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.